Check 1, 2. Check 1, 2, 3.
All right, thank you everyone for coming down this evening. All right, so I believe so today's topic will be on the gold and silver price movement outlook. All right, so we also have this event in collaboration with SocGen, who is the DLC distributor, and they also have more exciting new category of investment tools for you to look at also, which will be shared later. Right, so I hope you all enjoyed the food for those that are here physically. For those that are joining us online in Zoom, thank you for joining us as well. So this session will be both physically held at SGX as well as on Zoom and on YouTube as well. So for YouTube one, there'll be also a recording on the YouTube channel for Philip Capital. So if you do want to revisit the session, the slides and also the content, you can also look at the YouTube recording. So not to worry, yeah. Of course, if you want to take photo of the slides in between, you can feel free to do so as well. Right, so I understand that so right now our physical audience, some of them are still streaming in because they just finished their meal. Right, so we will also start very slowly to share some promotions first before we start with the event proper. Okay. So first one is that the newest promotion is that if you trade this new gold and silver DLC, right, you can get some rewards up to $388. So the T&C will apply. So to understand more about this promotion, you can go to our landing page for the gold and all right. So what is so good about that also is that right now DLC is also similar to ETF. There is no minimum commission, so don't need to worry that you are charging you a minimum commission for a smaller trade value. All right, you can just enjoy your percentage rate for trading in DLC as well for the Singapore market. So also, if you are already a POEMS account holder, or you are here with someone that is not yet a POEMS account holder, or you know someone, friend or family member, that could open a new account that is not yet an account holder, you can scan this QR code, input your existing account number to generate your unique referral link. With that unique referral link, if you get someone to open an account, you can get up to $100 worth of rewards, $60 per new account that you refer in this manner. So of course, there is some requirements involved. You can look at the T&C, but you can actually get rewarded for sharing and inviting more new family members or friends to join us as well. Okay, also on the financing rate itself, currently at 3.2% for Singapore, 5.88 for USD. All right, so we also know that right now, interest rate environment, even though it was on a downtrend along last few quarters, but right now there's also talks of potential rate hike. So of course, the rate might be a bit more stagnant or stable at these levels currently. But if you want to expand or leverage on your holdings or your capital, you can look at using leverage as well. Then share financing will be one of the ways to do so. If you're interested to find out more about this, you can either look for your trading rep or one of our staff outside as well. Okay, so also if you have shares held in CDP SGX, you're going to consider transferring to a Cash Plus or to a custodian-based account in Philip. You can also enjoy this promotion of a transfer in promotion of up to 188 in rewards for transferring your portfolio in SGX to us. Right, so of course there's a tier base involved, so you can find out more in the promotion website as well. Also, we do have the free SGX Market Depth currently. So if you are someone that want to use Market Depth, you can just click on the Market Depth function on the app or on the website. It's already activated for you. If you don't see activated, just check with your trading rep. It's free to activate as of right now still. Right? Also, if you have not yet joined our Telegram group, you can scan this QR code to join our Telegram group where we do share market summary, market links of the certain headline news and some news of what is going to happening around the world as well. Okay, so I'll be starting the pastime over to our this whole our event, this sponsor, right? SocGen will be sharing more about the gold and silver DLCs. All right. So I hope the event will be useful to you to understand more on how you can actually use or get exposure into gold and silver. After him, I'll also be sharing some part of the gold and silver outlook itself. Okay, so without further ado, let me pass the time over to Marcus.
Okay, good evening, everyone. Hi, my name is Marcus. I'm from Society General. All right, so we are the issuer of these daily leverage certificates that are listed on the SGX. I'll keep this brief, all right, because we have a new product launch that we just want to share with you. So hopefully it'll be more brief today. And after that, we can go into the outlook for gold and silver, which I'm sure all of you are very excited about. Okay, so just a very quick introduction first. Society General, we are a French bank. All right, so we're like the DBS of France, right? But we are also a global bank, global investment bank, and we do issue structured products across many different exchanges. All right, so our product is a structured product that's listed on the SGX. It's called Daily Leverage Certificates. All right, so these DLCs, as I mentioned, it's a structured product, but it's also a fixed leverage product. All right, so for those of you who are very familiar with leverage and inverse ETFs, the DLCs are exactly the same kind of payoff as your leverage and inverse ETF, giving you that leverage and inverse exposure to stocks, to indices. All right, so you have that leverage and inverse exposure. So we have the long DLC and we have the short DLC, so you can take a directional exposure to the underlying index or the underlying stock. Right, so your TQQQ or SQQQ in the US, if you're familiar, your 2 times Tesla, 2 times NVIDIA, leverage and inverse ETFs in the US, these DLCs have exactly the same kind of payoff as those leverage and inverse ETF, just that we can go higher in terms of leverage. All right, so we have 3 times, 5 times, and 7 times leverage. The US listed LNI ETFs are typically only 2 times, maximum 3 times. For us, we go up to 5 times, 7 times leverage because we're not an ETF structure, we are a certificate structure, but the payoff of the product is exactly the same as a leverage and inverse ETF. Okay, so these DLCs are all traded on the SGX securities market, just like a stock. So you buy and sell the DLCs the same way that you will buy and sell your Singapore stocks, Singapore shares, right? The same way that you buy and sell DBS shares, the same platform that you're using on POEMs, etc., or any regular stock brokerage account, the same platform that you buy Singapore shares, you can buy and sell the DLCs as well. All right. So the DLCs are an issuer-led product. SocGen, we are the issuer. We list it on the SGX, and we are also the designated market maker. So which means that we provide liquidity for each and every one of our over 200 DLCs listed on SGX. We provide liquidity on each and every one of the DLCs throughout the trading day during SGX market hours. All right. So we provide liquidity in the BNR's prices, BNR's volumes. So you can always see that there's always prices there, there's always volumes there, at least $500,000 on each side, $1 million on each side, for us providing liquidity for you to buy and sell the DLCs. Okay, so in terms of liquidity, it's always there. So when you see DLCs, not every single one of our 200 plus DLCs are traded every day. Some days, nobody wants to trade my Bilibili DLC. It's 0 turnover. That doesn't mean that there's no liquidity on the Bilibili DLC. All right, because you have to look at the BNR's prices, BNR's volumes. Even though it's 0 turnover, 0 traded value for that day so far in that day, you can still see the BNR's prices, BNR's volumes. SocGen, we are there providing liquidity for you to buy and sell the DLCs throughout the trading day. Okay? So we have been around for 9 years, all right? This is not something new. Please do not think that this is a new DLC is something new on SGX. We've been around for the last 9 years, and you've not heard of the DLCs. Where were you? Okay, the DLCs, we have been around for the last 9 years, and it's one of the most popular products on SGX because it really offers you that global exposure. All right, we have been punching above our weight on the DLCs. We're not just restricted to Singapore stocks. Sure, we do have Singapore stocks, your DBS, OCBC, UOB, Sembcorp, Capcorp. We do have that DLCs, but we also cover Hong Kong and the US markets as well. So we do offer, we have over 200 DLCs listed on SGX covering these 3 markets. So there's the index DLCs and there's the single stock DLCs. On the index DLCs, we go up to 7 times leverage for both long and short direction. All right, so you can see 7x minus 7x, so you can do a leverage and inverse exposure to Hang Seng Index, to Hang Seng Tech Index, as well as HSCEI Index. You have SIMSKI Index for the Singapore one, and you have NASDAQ, and S&P, and Dow Jones for the US listed ones. All right, so our most popular product is our Hang Seng Tech DLCs. 7 times long Hang Seng Tech, 7 times short Hang Seng Tech DLCs. People trade day in, day out, day in, day out, and the volatility on Hang Seng Tech is really nice. That's why people trade it quite often. right? Very regular trading on our Hang Seng Tech DLC, so do check it out. Our 7 times long, 7 times short Hang Seng Tech DLCs is the most popular one. Nasdaq also is very popular on our DLC, 7 times long, 7 times short Nasdaq DLC. But of course, more popular is on our 7 times short Nasdaq DLCs. People have been trading that a lot. But I don't know whether they make money or not. Okay, the US market is so resilient and so strong. Any dip on Nasdaq only, it rebounds back straight away. So even though people have been trying to call a top and trying to top pick on our Nasdaq using our 7 times short Nasdaq DLCs, but I don't know whether they're making money. Okay, all right. So, but on single stock range, we do have a lot of single stocks. This one is just a subset. This is just an example only. All right, example of our top 10 underlyings. But we do have more than 40 underlyings on the Hong Kong side, more than 20, 30 underlyings on the Singapore side. So the China tech giants, the China Terrific 10, Alibaba, Tencent, Meituan, Xiaomi, even SMIC, we also have DLCs on them, and we go up to 5 times leverage. Okay, up to 5 times leverage, long and short, leverage and inverse direction for the Hong Kong, Singapore stocks. All right, so you have 5 times long on Alibaba, 5 times short on Alibaba, you have 5 times long on DBS, and 5 times short on DBS. So Alibaba yesterday skyrocketed 12% up. All right, and I think we saw a lot of inflows on our 5 times long Alibaba DLCs. Our Alibaba long DLCs have been very popular, continue to be very popular over the years. All right, I think Alibaba is like very familiar among investors in Singapore. All right, but not so much on Tencent, but Alibaba seems to be the hot stock here in Singapore. People trade our Alibaba DLCs much more than any other Hong Kong stocks. So 5 times long, 5 times short Alibaba DLCs is quite interesting for you. DBS, DBS is only one of the counters that we see the most short DLC trading activity. All right, but also I don't know whether they're making money or not. Okay, but they're quite skillful. It's quite short-term trade only, 1 day, 2 day trade. But the small banks tend to see quite a lot of mixed activity on our 5 times long and 5 times short DLCs as well. All right, so you can go inverse exposure to the Singapore stocks. So there's right now in the last couple of weeks, we've seen a lot of contrarian investors come in because Singapore market is reaching all-time high, record highs today. DBS, $70. Woo! Above $70 today, DBS. All right, Singapore stocks are at an all-time high, so we do see quite a bit more activity on the short DLCs as well. People taking a contrarian approach, but of course for an outlier like Sembcorp, free falling like mad, Sembcorp. We do see a lot of 5 times long DLC activity on that as well. People trying to bottom pick. All right, so this long and short DLC, this kind of leverage and inverse exposure, we do see a lot of tactical, active kind of trading strategies. Hopefully you will find it interesting as well. On the US stock underlines, we have Max 7 stocks. So we introduced this in end 2024, and we expanded more than the Max 7 stocks. Okay, we've done Broadcom, AMD, Netflix, Micron, Palantir. Micron is our star product also in the last couple of weeks. Last couple of months, given that Micron has skyrocketed. Our Micron DLC went from $4 up to like $44, $45, 8x, in the last couple of months. So the US stock DLCs, we go up to 3 times leverage only. All right, for now. All right, we may go up to 5 times leverage soon, but for now, we only have 3 times long and short DLCs on the US stock. So Tesla, Nvidia, you can use a 3 times long or 3 times short DLC to gain a leverage or inverse exposure to the US stocks. And really, an instrument that's listed on SGX that gives you exposure to US stock is unprecedented. Never happened before in SGX history. All right, so this is really quite an interesting product. You can trade this SGX listed DLCs, in Singapore dollar currency, but give you exposure to Hong Kong stocks, to US stocks, and that convenience is what I think is why the DLCs are becoming more and more popular. All right, but today's highlight really is, I hope all of you got a gold or a silver pen today. When you come into the room. If not, please go outside. There is a booth later. Don't go out now. Later will always be enough. Outside the booth, we have a gold and silver pen for you, and as well as a flyer. All right, but because we want to highlight today that we have launched gold and silver DLCs. All right, we've done Hong Kong, Singapore, US. The next step, of course, is commodities. And finally, we managed to do our gold and silver DLCs, tracking the GLD and the SLV listed US listed ETF in the US. All right, so you do have now a gold instrument up to 5 times leverage, 5 times long, 5 times short on gold, and a 3 times long, 3 times short instrument on silver. Okay? But okay, I want to just, now I'm quite excited already, right? But I have to dial you back a bit. Okay? Don't get too excited right now. Let's go back to the basics a bit first, because I see a lot of new faces here today. I want to solidify your understanding of what the DLC can do. All right? So the DLCs is a leverage and inverse product. So the formula of the DLCs is as simple as this. All right. So the daily percentage performance of the underlying stock or underlying index multiplied by the leverage factor will equals to the daily percentage performance of the DLC. So if DBS, sorry, a bit outdated the slide. DBS is at $70 now, not at $50. Right. But for example, if DBS was up 2% today versus its previous day close, my 5 times long DBS DLC will be up by 10%. While my 5 times short DBS DLC will be down by 10%. All right. So your gains are magnified by the fixed leverage factor in terms of percentage terms. All right. So your gains are magnified, but also your losses are also magnified. So leverage is a double-edged sword, so be careful on that. If you get the direction correct, plus 10%. But if you get direction wrong, it's also times 5 minus 10%. Right. And if you are bullish, you buy the long DLC. But if you are bearish on the underlying stock or underlying index, you buy the short DLC. Because if the relationship is inverse right now, where DBS is down by 2% today versus its previous day close, my 5 times short DBS DLC will be up by 10%, while my 5 times long DBS DLC will be down by 10%. All right. So no matter what, you always initiate your position with a buy trade. You either buy the long DLC or you buy the short DLC. You buy the long DLC if you are bullish, but if you are buy on the short, but if you are bearish on the underlying stock or underlying index, you buy the short DLC because the short DLC will gain in value when the underlying falls. All right. The long DLC, straightforward, intuitive. Buy the long DLC, it will gain in value when the underlying goes up. Okay. So this is a number of our, I mentioned that our most popular range is the Hang Seng Tech one. So this is our 7 times long Hang Seng Tech DLC. This is a screenshot of our website. As you can see over example over here, 8th of April, this Hang Seng Tech is up by 4%. This is a normal day, quite a normal day on a Hang Seng Tech. All right, this is not like STI 1% every day kind of thing. But this STI is not bad, 1% gain every day. But this one can be 4% up, 4% down any other day. All right, so Hang Seng Tech is quite a volatile index because it's tech focused. All right, so 4% here, that's why you get that 28+% here on the DLC. That's where the 7 times performance is on a close-to-close basis. You will get that 7 times performance of the underlying index or underlying stocks percentage performance. All right, so the DLC are generally priced, below $2 generally. The US underlying ones generally above $2, but the price is just the price. All right, so the price itself will track the underlying based on that leverage factor. If this one today closed at 27.5 cents over here, and tomorrow 9th of April, Hang Seng Tech go up by another 2%. This then times by 7 is 14%. This 14% gain is with reference to this close here today on 8th of April of this 27.5 cents. So this 27.5 cents will increase by 14% up to that, maybe 30+ cents level. Okay, so that happens every day on a close-to-close basis. You get that 7 times performance of the underlying stock or underlying index percentage performance. Of course, again, gains are magnified, but losses are also magnified. But that's where the 7 times is, right? So up 4%, this one also down 28+%. All right. So that's where the 7 times performance is, and it happens every day on a close-to-close basis. This kind of performance is standard for all fixed leverage products, all leverage and inverse products out there. L&I ETFs, leverage and inverse ETFs also have this sort of concept. Right. So from here, I think it's quite clear right now that this formula, this product, not a warrant, not an option, not a margin product. Okay, so this is entirely different from your options or your warrant. There is no implied volatility, there's no time decay, there is no strike price, in the money, out the money kind of concept, nothing like that. All right, so it's not a warrant or option, don't think in that terms. This is more like a leverage and inverse ETF, a fixed leverage product that gives you that fixed leverage factor of the underlying stock or underlying index daily percentage performance. All right, and not a margin product, so you don't have to go and put in $5. It's not margin basically. All right, so it's not margin product like broker margin or CFDs. This is not a margin product. The leverage is inbuilt into the product itself already, and not based on the margin that you put up front. So that also means that you will not have the risk of margin call on this product. If you buy $1,000 worth of SYHW, the maximum you can lose is also $1,000. Right? You cannot lose more than your invested amount, like margin products. All right. So if this Hang Seng Tech drops by what 20% down, times by 7 is 140% loss. You're not expected to cough up 140%. All right. The maximum loss, as painful as it is still capped at $100, 100%. But you'll never be asked to cough up the extra 40% loss. In that case, unlike margin products, where potentially you can have a margin call. Okay. So gold and silver, our highlight today is what we launched today. The underlying is an ETF. All right, the underlying is the gold ETF and the silver ETF that's listed on the US exchange. All right, so you might know of this already, GLD or SLV. If you're in tune with the US market, you should know that there is this GLD listed on the US and an SLV. For us, the DLC tracks this gold and silver ETFs with the leverage factor. So we have 5 times long, 5 times short on gold, 3 times long, 3 times short on silver, and it's all traded in Singapore dollar currency. All right, so you don't have to go to the hassle of changing your money into US dollars. You can just trade it directly using Singapore dollar currency to gain exposure to a foreign or another asset class that is actually denominated in US dollars. Okay, so the codes are over there. So if you go to your broker trading platform, I hope you're using Poems, but any regular broker trading platform, if you key in GLDW, you will see this gold DLC over here. If you key in SLS over here, you'll see this silver 3 times long DLC over here. So remember, if you're bullish, you buy the long DLC. If you're bearish, you buy the short DLC. Okay? You can find the name over there, long and short in the name also. So I know US listed ETF, gold and silver, it might not be so familiar. If you're not so familiar with it, it tracks the underlying spot gold and underlying spot silver, and it's 99% correlated to the underlying spot price. All right, so GLD is 98% correlated to spot gold prices. SLV is 98% correlated to spot silver prices. So even though the DLC underlying is an ETF, but it should track very closely with the precious metal spot prices. Okay, so this one is to assure you that it will still track, even though you're trading a DLC on a gold ETF or a gold DLC on a silver ETF, it's still very correlated to the spot prices. The 2% that is not correlated is due to the management fee of the ETF that caused the correlation break. But 98% is very highly correlated already. Okay. All right, so I think gold and silver, maybe you don't need so much of these slides. Maybe I think Huan Zi will look into it more later. But the main thing is gold was one of the most popular and strongest asset class last year. All right, but this year to date, all right, it has peaked at January, 29 January, it picked it up to 230% in the last 2 years, 115% up over there compared to the STI, Nasdaq, and SPX. It's outperformed them in the last 2 years. But in the last 6 months, in the year to date, it has actually one of the worst performers among all the other equities underlying equity indices. Yes, it's down by 18%, down by 7% on gold. All right, but I think this is where opportunities are. If I ask you to look at our gold and silver DLCs over here, you'll be like, my lah, too risky already. It's like, oh, you're gonna drop anytime already. It's too. The train has left the station already. But now the train has come back to the station. Has it? I don't know. Huan Zi maybe can advise. All right, but now is a good time. All right, gold is hovering at 4,000 level, 4,001. Is it gonna go up? Is it gonna come down? But we are at a critical point now. All right, turning point, inflection point now, for you to decide which direction you want to play. Right, but here I am. I'm here to give you that tools for you to express your view. If you are bullish, 5 times long. If you are bearish, break below 4,000, you want to go short, 5 times short DLC for you to choose. Okay, but I think it's really quite a good time that we have this, because I think it's really an inflection point, and I think it'll be quite interesting to see how these precious metal prices will go in the next 1 or 2 months. Okay. So just a quick one on our gold. This is the gold DLC GLDW. So this is as of 1st July. This is our short. You see the inverse relationship over here, right? The red color one is the DLC. The black color one is the underlying ETF. So this is our 24-hour basis. All right. So you can see how it's inverse relationship. The other one is together. It moves together with the underlying. All right. The gray bars is the US hour. All right. So I'll go a bit more into the US hour thing later. Hopefully I have time. But the US hour, you are not able to trade the DLC. All right. So this is tracks the US listed ETFs. So it will maintain the exposure overnight. Everything, you might see a gap up, gap down in the morning. But you can see that it tracks on a 5-day basis, right? It's been tracking quite closely the underlying, but you cannot trade the DLC during the gray bars, the US hour session. You can only trade the DLCs during SGX market hours. Same with all our other US stock underlying DLCs. You can only trade it during SGX market hours. Okay, but it will have that same 5 times or 3 times exposure to the underlying US stock, underlying US ETF on a US coast-to-coast basis. It will keep tracking them. And then the short is a inverse relationship, right? Because underlying drop, then the short DLC will gain in value. Silver one over here, the long DLC, SLSW. Okay, take picture already. Okay. And 3 times short SLV, right? But you can find all this on our website, all right? So on our flyer that you have, the website name is at the back, dlc.socgn.com. There's a QR code as well. You can find this on our website, all right? So US stocks and US listed ETFs like the gold and silver, for example, we want to touch on that a bit on how it works. All right, so this one, US stocks, we have the Max 7 stocks, 3 times long and short. And then for the other non-Max 7 stocks, Netflix, AMD, Broadcom, Palantir, Micron, we also have them as well. And they're all traded in Singapore dollar currency for this one. Okay, so US stocks and US ETF, same concept. I want to quickly explain this part before I go on to the last 2 parts of my segment. All right, so during SGX market hours, right, when the US market is closed, this US listed ETF, this US stock, Max 7 or whatever, Micron, is closed, right, for trading on the US hours during SGX market hours. So the market price of this US stock DLCs, right, and US ETF DLCs, right, will be closely linked to the performance of the US stock or US ETF traded on the alternative trading systems during Asian hours. What are these alternative trading systems? All right, so this is actually the overnight trading session that I hope that you guys have heard of. If not, let me introduce. All right, so Philip has that 24/5 US stock trading, right? So during Asian hours, there's that overnight trading session. Other brokers, fintech brokers as well in Singapore, they offer that overnight trading session for US stocks as well, meaning that you can trade US stocks during Asian hours. So there's actual price discovery of Tesla shares of this GLD during Asian hours. All right, it's an overnight trading session. During Asian hours, there's the actual trading price of all these US listed ETF and US stocks. So we do have, this is the SLV traded at 1:55 p.m. on 1st of July. This is the Asian hour price, the overnight price. All right, so we do track this overnight price during Asian hours. All right, so during Asian hours, you will track the overnight price. And you can, I mean, on Philip platform or even on other fintech broker kind of platforms, you can see this overnight price of the US stock during Asian hours. All right, so on a US close to close basis, how does it work? All right, so let's take an example over here on the left over here, right? The US stock closes at $100 at 4 a.m. this morning, Singapore time. All right, US market closed, the US stock closed at $100. Same concept for the US ETF on the gold and silver. All right, close at $100. The DLC price is at $1 this morning, 4 a.m. time. And say the company announced better than expected earnings results, right? And then come 9 a.m. Singapore time, this overnight price of this US stock is up to $106 already, this US stock, because it reported very good results after market close, right? Up $106, so it's up 6%. The DLC will give you that 3 times long. So it's a 3 times long DLC, will give you that 18% gain, right? So at open, SocGen will be quoting the DLC at $1.18 over here. And if you think that, okay, this US stock will continue its bullish momentum, I want to trade this GLD DLC, this gold DLC, or this US stock DLC, I think you'll go further, you're getting early ahead of the US market open, then you can buy the DLC at $1.18 at this point, 9 a.m. Singapore time. And if indeed your view is correct and the overnight price of this US stock continues to rise further during Asian hours, SGX market hours, then just before SGX market close, the stock is trading at $110 already, up 10%. So my 3 times long DLC will give you that 3 times performance, right? So up 30%. So it'll be trading at $1.30. All right, we'll be quoting, SocGen will be quoting the DLC at around $1.30. At this point, you can choose to sell back the DLC to SocGen at $1.30 to lock in your profit of $1.30 versus your purchase price of $1.18. So 12 cents profit, you can choose to lock it in. You buy in the morning from SocGen, you can sell back to SocGen at before SGX market close at $1.30, lock in a profit of 12 cents for DLC and call it a day. But if you want to maintain that exposure, if you are a bit more greedy, okay, you think that the stock will rise further, you can choose to hold on to your DLC after SGX market close, all right, but you cannot manage your position after that already, okay? You cannot manage your position after that until the next day SGX market open. But the DLC will continue to maintain the exposure, the 3 times exposure to the US stock. So if overnight US session, regular hours, US stock continue to rise further to $115, up 15%, my DLC should be up 45%, and the value of the DLC should be at $1.45. All right, but at this point, US market hours, you cannot sell back to SocGen, right? Because SGX market is closed. You can't sell back to us at $1.45. You have to wait for the next day, 9 a.m. Singapore time, SGX market open. If the overnight price of this US stock is still at $115, we will be quoting at $1.45 here at 9 a.m. Singapore time. And then you can sell back to SocGen at $1.45 to lock in your profit of $1.45 versus your purchase price of $1.18. Okay, so that's how the US underlying US stock or US ETF for the gold and silver work on a 24-hour basis. All right, on a US close to close basis, you get that 3 times or 5 times exposure to the underlying stocks, underlying ETF percentage performance. But you cannot, but you can only trade the DLC during SGX market hours, and you cannot trade the DLC during US market hours. Okay, so I think this is what you should know about the US underlying ones. But I mean, if you are not active trader, not a scalper, you're not gonna stay at night to really like manage your position. You don't mind holding it for a few days or a few weeks and see how it plays out. not too bothered, about the overnight US session, then these DLCs could be something for you. And if you want, especially if you want that convenience of a SGX listed instrument, or you want that leverage factor, you want that traded in Singapore dollar currency, and it's all that SGX listed instrument, you are paying SGX trading fees, etc. Then you can find this comfort in these DLCs, even though there's that overnight sort of like inability to manage your position. But you have a new trading window during Asian hours. All right, so that's a bit of a trade-off. All right, so AMD, the title is not Micron, this one's AMD, 3 times long AMD. Stock code is Z4WW. This one, you can find the overnight price over here. You can see how it moves with the underlying across the different sessions. All right, and then this one over here is AMD earlier this year, June, right? So in a 5-day, 1 month, 6-month period from 1st of Jan to 30th of June, AMD gained 170%. This 3 times long DLC Z4WW gained 639%. All right. So this one you can see over here, even though AMD gained 170% only times by 3, right? 3 times long, it's only about 510%, right? But the DLC gained 639%. So more than the 3 times performance. So for leverage and inverse products, something you must know is the compounding effect. All right. You can get more than the 3 times leverage, more than the 5 times leverage, if you manage to capture a nice trending market and you have that compounded gains. Okay, I'll jump forward, all right, to this part on the compounded gains, because I think it's important, all right, that if you're holding the DLC for more than a day, you need to understand this concept. All right, I'll end off with this because it's very important, all right, to understand compounding effect. Right, for anyone who trades leverage and inverse products, including leverage and inverse ETFs in the US, you need to understand compounding effect, where it can work for you in a nice trending market, but it can work against you in a sideways or volatile market. So this one you saw AMD 170% in gain in a 6-month period, but the DLC gained 640%, more than the 3 times performance of AMD percentage performance because of the compounded gains. So this example over here, underlying is up by 1% on day 1, up by another 2% on day 2, up by another 2% on day 3. So 3 consecutive days of gain, cumulatively 5% gain. This DLC, every day you get the same 5 times performance, right? 5 times. So you get 5% on day 1, you get 10% on day 2, you get another 10% on day 3. But the gains are compounded. Every day the 10% is based on a higher base. So you get a 27% gain cumulatively. So that extra 2% gain, because 5% times by 5 is only 25%, right? The extra 2% gain is because of the compounded gains, right? So in a nice trending market, you can get that compounded gains and enhance your return to more than the leverage factor, right? But in a sideways or volatile market, that's where it will work against you, right? So the underlying is up by 2% on day 1, down by 4% on day 2, and then up by another 7.31% on day 3. So rebound back after that. Cumulative gain, 5%, same as this, 5% gain. But the 5 times long DLC, every day you get the same 5 times performance, up 10% on day 1, down by 20% on day 2, then rebound by 37% on day 3. All right, but the cumulative gain is only plus 20%, less than the 5 times performance because of the compounded gains. Compounding effect, not compounded gains, compounding effect, where the losses on day 2 is locked in, and then the rebound on day 3 is based off a lower base over here. All right, so the compounding effect will work against you in a sideways or volatile market, and that's the reason why I say that the DLCs are not long-term buy and hold instruments. Okay, short-term. Intraday trading is popular. Intraday, a few days or a few weeks for a nice swing trade or a trend trade, but you should not be holding the DLCs for months or even a year because of the, I stress it's because of the compounding effect, right? In the long run, markets are generally sideways. Okay, whatever that goes up must come down, whatever goes down must come down. All right, the longer you hold on to the DLC, you are at risk of it becoming a sideways or volatile market, and that can erode your returns or that leverage performance because of the compounding effect. Okay, so intraday, a few days or a few weeks, please do not hold on to the DLCs for months or even a year. All right, so I think over here, cost and fees, there is a funding cost for all our DLCs. All right, so it's not like time decay where you accelerate towards expiry. No. This is a funding cost, overnight funding cost. So if you buy and sell the DLCs during the day, you buy in the morning, you sell before HX market close, sell it to SocGen, there is no overnight cost. There's no funding cost. You just pay your broker commission, that's it. And exchange fees, sorry. But SocGen, we don't charge anything if you buy and sell within the same day. But if you hold overnight, we have to charge you an overnight funding cost to give you that leverage, right? So this overnight funding cost can be, say, example, 10-15% per annum. This 10-15% per annum divided by 360 days, all right, that amount is deducted from the price of the DLC every night. So if you buy a DLC today at close at $2, for example, the next day, market open, if the underlying stock never move at all, but technically the DLC value is actually $1.999995. Right? Because overnight we will deduct the cost and fees, the overnight cost from the price of the DLC itself. It's not charged to you separately. Okay? All right. This one is something that to know, but not something to worry about every day. It's an intraday reset mechanism that can happen if there's a big volatile move on the underlying stock that goes against the direction of your DLC. So if you buy a long DLC and the underlying drops 15-20%, this intraday reset can occur. All right. But if you buy the short DLC and the underlying drops 15-20%, no such thing as the intraday reset. You will be sitting on 150% gains or 200% gains. So there's no such thing if it's in your direction and you're making money. But if you are suffering losses, this can happen. This intraday reset mechanism can happen against the direction of the DLC to reduce the exposure after that. All right. So what happens is that after it gets triggered, 15% move on the underlying stock, 20% move on the underlying stock based on the trigger levels over here. Right. This DLC will be suspended for 30 to 45 minutes. For us to do an intraday reset of the leverage factor. After it resumes trading, after that suspension in the same day, it resumes trading, the 5 times or 3 times leverage factor is based on a new observed level that is determined in the first 15 minutes of airbag trigger and not with reference to the previous day close anymore. Right? That happens for an intraday scenario. So that after it resumes trading, the leverage exposure is actually reduced after that. Okay? So if the underlying drops further, you will lose less. But if the underlying rebounds, you will also affect your ability to recover your losses as well. Okay, so this happens in a very extreme adverse move on the underlying stock or underlying index. Doesn't happen every day. Indices don't move 10% every day. Stocks don't move like 20%, 15% every day, but it can happen. All right, so just something to take note of. And we have more illustrations of this so-called intraday reset mechanism on our website under the education tab. So you can find more information on our website, dlc.socgen over here. Right, you can find the education tab over here where we have more illustrations on the compounding effect, the intraday reset mechanism, as well as the full list of DLCs under here, our DLCs. We can find all our Hong Kong, Singapore, US, and commodity DLCs all over here. So you can reference the DLC, choose the DLC that you want over here, see the price, see our bid and offer codes over here, but you still ultimately go to your broker trading platform to buy and sell the DLCs. Okay, so more resources over here. We have a dedicated US market tab as well for all the US listed underlyings, including the gold and silver DLCs. And lastly, we have a hotline number over here. For those of you who are new, I encourage you to have a look at the website, and also any questions at all, give me a call. All right, my team and I will stand by during HS market hours, 9 AM to 5 PM, to answer any questions that you have on the DLC. No such thing as stupid questions. Okay, so just give me a call. Tell me that you are looking at the DLCs. What are you looking at? What are you interested in? You know, any advice? You have any advice for me where to get started? Happy to just have a chit chat over the phone. Okay, so give me a call over here on the hotline if you have any questions. This website, the URL is on the flyer that you have. If you don't have a flyer, you can get it one outside on the booth. And also, you can also please visit our website for this. All right, so we have the gold and silver DLCs that we just listed 2 weeks ago, 3 weeks ago. It's been quite nice, good start. We see trades on all our 5 times long, 5 times short, 3 times long, 3 times short, gold and silver DLCs. Of course, a bit more attention on the gold. But I think we really are, I think it's right now, gold is at the right moment. Okay, I think it's a good opportunity lah. Okay, I don't know whether it's going to be a good thing. Depends on where your bias is or what your horizon is. But I think gold at the 4,000 level now, interesting to watch. Okay, to see how it progresses. And whether you buy a ETF, gold ETF, or whether you buy physical gold or not, I hope you can keep in mind that there's actually this gold and silver DLC, 5 times long, 5 times short. And also this silver DLC, 3 times long, 3 times short, for you to do some of your more tactical positioning or capture any opportunity that you see in the market. You see gold tank, after that you can go 5 times long on it for a short-term trade also can. All right. Like yesterday, Trump announced ceasefire over kind of thing. And then gold tanked. That would be quite a nice opportunity at 4 PM Singapore time to actually go on 5 times long gold. And we did see some trades as well. Okay. So hope you can check out our gold and silver DLCs. The flyer is there. And I think I'll be outside as well. You know, if you have any questions on the gold and silver DLCs later, but I think I want to give some time, sorry, I think I overrun already, on gold and silver because I just want to know where is it going to go. All right. Thank you very much, everyone.
Right. Thank you, Marcus. All right. So I hope everyone have a great insight on the DLC for both gold and silver, right? Where you can learn more about how you can actually get exposure. All right. Okay, so basically, we have only some time, so I'll just share very quickly and also on the main points on the gold and silver outlook itself. Right. So basically, if you have not been trading or if you have been trading, you will know. Right. So gold have reached the record high right in January 2026 expansion by Marcus as well. Anyone know roughly what level? 5,000 what? 5,006 actually. Right, 5,006, 5600, a bit more, right, along the way. So that's the record high that they have reached already. And there's a very sharp correction in Q2, right? So it went down to as much as below 4K at one point of time. But right now, of course, it's back up to around 4K, 4.1K, that range, right? So one of the key factors that have been mentioned a lot of times in the news, if you follow the macro that is on gold and silver, is on the impact of the higher interest rate environment on the gold and silver as well as the US dollar index performance, which I'll touch on later. Okay, so basically, right, if you look at gold and silver, you need to understand what they are doing first. First one is gold is used as what? Used as a defensive asset, right? Within the precious metal, the range, they are the defensive asset. And the near-time upside usually are more limited based on the current interest rate environment, which is on a higher end. Right, so even though they're saying that the last few quarters there was rate cuts and everything for the US market especially, but you must understand that US have still very high interest rate environment if you compare to past where there's a zero interest rate environment, where there's a lower interest rate environment, even for the past few crises, if you compare the different time periods, right? So in terms of the performance of gold when interest rate is high, you hold on to gold, the gold is not going to grow by itself. It'll just be the gold, right? So it's stagnant itself. It's a good defensive asset on volatility period of time and a good hedge to inflation. But in terms of high interest rate environment, you are losing out on the interest rate. So like it's either you hold a US treasury that's giving you high interest, or you're holding gold to have a hedge against the market inflation as well as the market volatility itself. So for silver, it's different. Silver is actually offering high beta exposure. So if you're not very sure what's high beta exposure, basically it means that there's very strong correlation in silver with the stock market actually. Right? It's not like inverse or defensive or whichever. Silver have actually a very high correlation to certain segments of the market, not the whole stock market as a whole, but certain segments, right? And especially because they are very highly utilized in a few different sectors, like electronics, like also on AI growth, and also on renewable energy, for example. Okay, so let's start with the gold itself, right? So what is some of the bullish case that we have for gold? First one is that gold consistently, one of the key drivers, even before it reached above 4,000 in 2025, was that central banks are keeping the hype and buying more gold. Of course, there are central banks that are selling gold when the price was going up. But in general, there's still more central banks buying gold. And for consecutively 20 months, China also added, and China is one of the countries that keep on adding in a very large way. Other than China, also India also is mainly one of the main central banks that's adding gold as well. And one of the key reasons why they want to buy more gold, right, for their reserve is that they want to diversify away from US dollar, meaning they rely less on US dollar being the reserve in the country, right? So right now the demand, even though there's fluctuation and there's up and down in various central banks, is still above 2022, right? Where the whole average, you see the run up from 2022 to now, central banks have been buying consistently, right? And central banks, when they are buying, they usually are long-term buyers, means they won't buy today and sell tomorrow. Right? You won't expect that. You expect maybe a long-term buying spree. And even if they want to sell, it might be a few years down the road, where they might liquidate partially to get some liquidity. So when they are entering the market, generally they are giving you the additional floor, the additional type of structural floor, which is more of like a support level for the prices itself. Second one is that the safe haven demand, even in terms of retail investors or even in terms of hedging, is still there, right? So tensions has been flip-flop, right? So I think some people, they might know, right? Trump has always been having a different flip-flop positions on his Middle East tensions, on the Strait of Hormuz situation. And even US, Iran, even the Ukraine, Russia side has always been on a flip-flop situation. And trade uncertainty is also there. So as US also have different trade deals that might be not continuing or might have been discussion for newer difference in terms of how they're going to set up a new trade relationship for future. Okay, so right now the safe haven demand in terms of the trading aspect is still there. And the last one is basically there's a structural de-dollarization, meaning that central banks want to reduce the USD. All right. So geopolitically, if you want to reduce your reliance on US, you have to reduce your reliance on US dollar, right? If not, you will still be somewhat very highly exposed or correlated in terms of the US stock market, the economy, to your own economy because of your reserve in US dollar. And you can see that by not only seeing the gold, central bank buying gold, you can also see that by how much they have been selling off or reducing the positions in the US Treasury bills, right? So gold is just one of the alternative monetary assets. And of course, gold is not the only one. So you can see that some of the central banks are also starting to explore even cryptocurrencies to consider some of that in their reserve. Even Singapore, the central banks have been looking at, MAS have been looking at potentially how cryptocurrency can be part of this reserve itself. Okay. So for bearish side, not all is good and up, right? If not, gold should be above 4K, above 5K, above 6K even now. So right now, why there's this so-called correction or sell-off for the gold, the main factor that they say is actually the high interest rate environment, right? First thing, right? US Fed have been delaying rate cuts, all right? And now even there's now half between rate cut and rate hike. So if it's back to rate hike, technically it's a negative news for sure, all right? And bond yields remain elevated, meaning that they don't expect. Okay, so US Fed is what they guide, right? And bond yields in the market is actually what the market expects that is happening. And if the bond yields remain high, it means that the market really expects that the Fed will not cut, right? If the Fed say that I might cut one time or two times this year, and you see the bonds yield will start reflecting that exposure. Or right now, even though the Fed say that I might cut, I might hike, but then end up the bonds yield are not moving. The bonds yield are actually going up actually. And that in that case is becoming a negative headwind for the gold price in correlation. And with the bond yield higher, as mentioned just now, the opportunity cost of you holding gold increases, and that's why there is a potentially a sell-off there. Inflation is persistent, right? So this is the flip side. Inflation persistent will weigh on non-yielding assets, correct? But if inflation is high, it will also eventually, on the longer term, middle to longer term, bring up gold price. Because gold price is actually tied to inflation, right? In a sense, in terms of the valuation wise. So it means that the monetary power of gold should be actually correlated to inflation. So if inflation go up, actually gold price does go up. So there is a long-term effect versus a short-term effect. But the short-term effect is that inflation high means that the rate cut will not happen, and that's the negative part to gold. That's why the shorter term, the time frame wise, why gold is moving more negatively than if inflation is high, it's supposed to be good for gold, right? So there's a timing issue. Okay, the last few points, smaller points, but US dollar being strong, all right? Same thing as the EU side. If it's too strong US dollar, if you're buying in terms of USD, if USD goes up in terms of valuation to Sing dollar, for example, in Sing dollar point of view, when you look at gold, the value of gold is still very high because now US dollar costs more to you, but you're buying the gold in US dollar. So if USD goes up against Sing dollar, you are seeing the gold is still expensive in Singapore point of view when we're looking at from Singapore point. And generally, you see that in 2026, Q2 especially, there is a very modest net outflows of the gold ETF, and that you can see in terms of the AUM of the ETFs, and you can also see based on maybe also profit-taking sentiment in the gold market. Is in compared to 2025, where there's a very, very strong net inflow of the gold ETF market, right? So basically, that very strong gold performance all the way to Jan 2026 definitely played a part. When the sell-off comes in, everyone is rushing to take profit. They do not want to be left behind because the climb was very, very fast. When the climb was that fast, there wasn't a lot of room to actually have a floor or so-called have a support level where there are more investors that are willing to hold the position. Central banks buy and they don't sell, yes, but when you keep on buying to a point, I think in Singapore, you know, some of the elderly, some of our friends, they go queue at the gold shop, they start queuing up, asking those gold jewelry shops whether they have the gold bar, the small ones. So when you see this queuing up sentiment, and when you start, if you remember the news last year, towards the end of the year, you start seeing the news having that hype for buying gold. That's actually when you are an investor, you might know that this might be towards the end of the uptrend, where the retail side is really all climbing in. So in that same sentiment, the institutions, investors might be also looking for a way out because they have a very large position. So when retail is coming in for the final swing of the hype of the uptrend, usually insti traders that are shorter term in frame, they will choose to exit during that period of time. Okay, so for silver is very different. So silver is being positioned as one of the key drivers and utilization in terms of for AI and infrastructure. So they are used in semiconductor, electronics, data centers, power management systems, and connectors. So basically, you see A, B, C, D, E, so many different points. All of them are related to the AI, the overall mega trend. Okay, so this is definitely one of the main case of why silver went up so much last year. Solar energy also need silver. Of course, solar energy, the adoption might be slowing down, but longer term clean energy direction is still there. EV as well is also using a lot of silver, right? So EV, generally, if you're going to have more electronics inside the EV of car, of course, you're going to use more silver because it is a much higher utilization than internal combustion cars, which is the usual cars that we have. And also a historical supply deficit. So this is a key point which I think is relevant if you're not aware. Basically, it means that the mine production for silver is not catching up as much as the industrial demand is increasing. Right, because previously, when silver has been very volatile, right, silver price being volatile, the mine production, they will not directly invest to pump their production, unlike gold. Because gold, even if they pump production, even if they cannot sell off the gold, they can hold, because gold is actually quite valuable for a same weight, for a very small amount of gold. But imagine for silver, you need a lot larger in volume for the same valuation. So you need storage costs, you need transportation costs. And if you're going to wait, if you are wrong in terms of the price trend, the miners do not want to be having an inventory of a very large silver inventory. So they are slower to react to the demands increase. And thus the supply side is still not yet catching up to the overall demand in the overall terms, right? So of course, even though in the short term, maybe there's still some catching up already, but in general, the supply deficit is still ongoing across the world. Okay, so next one also the manufacturing weakness. This is the bearish case. So manufacturing side, one of the key one is China, and you see China has also been a bit more volatile in terms of the manufacturing weakness. Of course, if you talk about specific, the lower end electronics is quite weak, but the higher end, the data centers, your connectors, your memory chips and stuff, they're all pumping up demand. And actually right now, in that sense, we do not really see a very strong manufacturing weakness coming in to this year, end of year, and next year. We should see a recovery actually. And China's slowdown actually now still ongoing, but we believe that the Chinese government will actually step in soon if, let's say, the overall market continues to be stabilized. And if the US Fed really stop in terms of their rate cuts, then the China government will start to having their own monetary policies to come in to push the market. Because generally, China has been waiting for US Fed cut rates so they can cut on their end as well. So if US is going to stop or pause, so-called, their rate cuts, then China needs to start doing their other actions to help the market instead of relying or waiting for the monetary policy. It might move into the physical policy side of things. Okay, so outlook-wise, generally, I'm still bullish on gold. Right, 4.5K is my base case, currently around 4.14K that zone. If the macro uncertainty continue to persist, meaning let's say the US-Iran really start to escalate again, in the short term to medium term, actually, I potentially look at potential swings to 5K, but it will be a swing. It will not be consistently pump to 5K and then stay there, right? So it will be a swing and it might potentially touch 5K. That's my take for 2026, right? So net inflows is still very high, 89 billion worth, all right? And then we see that the physical ETF have a lot larger AUM and so-called valuation in February 2026, 701 billion. And in Singapore, you can also see there's also new gold ETF listed. So in terms of avenues for you to start getting exposure to gold, there is 4 different ETF in Singapore. There is two ETF, but 4 different share classes. Then there's also the DLCs that is shared by Marcus just now, if you want the shorter term time frame in terms of both bullish and bearish. So there is definitely avenues for you to look at for gold. All right, so you see actually from the peak, which is the left-hand side, the top part of the dotted line, right? The peak part coming down, you can see there's a downtrend all the way to this level currently, where we are at now on the right-hand side, in the green zone. The green zone actually you see is actually back to the left-hand side, the very far left-hand side, which is the around October, November period. So that's how extreme you can see. It was actually around 4K even in October, November 2026, but it pumped all the way up to 5K within 2 months. That's why I say that there wasn't much support level, because it was a very fast climb. As compared to the climb to 4K, it took generally around 6 to 7 months for whole of last year to reach that level before that final pump up. So right now, this level we see actually have a very strong support zone. And the base level wise, I'm looking at 3900 and up to 3700 in terms of the support zone, right? Where the swings should stay within that level if there is any negative outlook for gold itself. Okay, for silver wise, the ETF is significantly smaller if you compare to gold. So silver is really for the investors that really want to potentially trade in a belief of its reliance on industrial or AI's dominance in a sense, right? So it's very volatile, right, for sure, for silver. So if you are someone that want to have a lower volatility for hedging, then silver might not be the best case. But if you really want to participate in the cyclical movement without directly entering into the industry that is very volatile, like AI directly, silver is a good proxy for AI exposure in terms of the price movement, right? So it's very closely related to the industrial growth expectations. So in the same correlation, it is cyclical for sure, right? And silver itself, right? You can look at the outlook as well, same thing. So silver, the jump down was a lot higher, and you can see actually from this, if you compare to this with the gold one, the rebound up is a lot lesser. So when the gold have the first correction, there was actually a very high retracement back up before its continuation of the downtrend. But for silver, when it went down all the way, this level, right, from 1-2 something, 1-2, 1-3, 1-4 area, jumped down all the way to half price, around $64, $65. It only rebounded back up to 92. If you compare to gold, which rebounded back to above 5K. All right. And then now it's back down to around 60 region. All right. So we do see that upside wise, it might find it hard to break 68 in the short term, right? Because AI has already been so bullish. Silver have not yet caught up in the whole overall side of things. So the whole demand trend of silver itself is that it's still digesting the previous pump and dump in a sense for last year. And if you want to see it move in line with the cyclical movement of the industrial side of things, it might take the second half of this year, right, to actually stabilize. But if, let's say, the Iran side, the Middle East, and oil still continues to be very volatile, silver might actually still see weakness because people are still funding in mainly the fund flows in gold, in oil, in direct AI. So silver might not be the first priority in terms of what they are going to pump their fund flow into. But if you look into from next year onwards, when production levels is already almost peaking, the outlook for the memory cards, memory chips, your graphic chips and all that, the chip makers, they have already locked in their contracts for next few years. So there's not going to be a lot of volatility. So when the chip makers are stabilizing, then they will move into the raw materials, which silver is one of the key raw material for the AI side. So that's my take for this. So it might be slow for this year, but it might be good for you because being slow for this year means that you might have the opportunity to enter or get some position in a relatively suitable level for yourself. That is something that you're comfortable with at a lower price to position for next year's increase for silver price. All right. So that's mainly the thing for today's session, for the sharing. Right. So thank everyone for joining us today. So I just want to revisit also the promotion in case you are not aware. Currently, this promotion is already available. Go to the Points 3.0 app, go to under rewards, under me tab, claim the coupon. You can actually get up to 388 terms of rewards. If you participate in the promotion, you can find out more from our promotion webpage. If not, if you have any questions, you can also feel free to raise a hand or maybe ask a question. You can take a question as well. Thank you all for joining us for this evening. Okay, any questions? You can also come down lah. I think also reach 8 p.m. in case you want to break everyone. Yeah.
Question on the gold side and silver side. Yeah, markets one the physical, the other paper side. Now, this one side management back to the number of people who just 1,000 people per thousand. Now, aggregate people. Coming time. So in that sense, you can take a manipulate the price. I'm not sure. Type of tag.
Okay, so for the question itself, paper gold might seem to be very large, but actually, I would say, in terms of our gold market lah, right? In general, there isn't going to be a open position, meaning there is no exposed paper gold with no one hedging it. So the hedge must be eventually going into a physical gold, right? So someone is hedging it through a physical ETF or through a position or futures contract. So basically, paper gold will not be naked by itself. No one wants to be a naked paper selling you paper gold, and I take all the risks. If you buy, it means that I'm negative on gold, which is not going to be anyone going to be have a long-term negative on gold position for himself or for any FI. So definitely they'll hedge the risk out. So they'll buy something to hedge the risk to pass the paper gold to you. So in a sense, eventually the exposure that you have, that you're saying on paper gold, is going into physical gold. In that sense. Yeah. Yeah. Gold chart. Sorry. Yep. Yep. Okay, so you must understand that it's not inflationary pressure. Okay, so there's a difference. Last 2-3 months is inflationary worries. You are worried that the oil prices movement will increase inflation, right? That will indirectly increase or decrease technically the chances of the Fed cutting rates. So that's the correlation. In terms of the actual inflation rate US is facing now, it's not high. The actual number itself is not high. You go check the numbers itself, it's not very high right now. It's higher based on, you look at the oil prices impact to the overall inflation. But if you look at just core inflation, you look at Singapore inflation, look at overall market inflation, it's not at a high level. You know what I mean? So if you're saying that if you see a trend where US inflation is going up consistently, right, where there's an uptrend for inflation, you definitely see gold going up. So not 2 months, not enough to see. You need 2-3 months, actually even 4 months of trending inflation going upwards. Then you will see that the gold will move in line with the inflation direction. That's what I mean by inflation generally should move in line with gold, which means go up and gold will go up. But in the short term, inflation go up, gold is going down because of that shorter term correlation, which is inflation go up, Fed don't cut rate, interest rate is high, gold go down. That's short-term pressure. So short-term pressure is outweighing the long-term pressure for now, which is why the gold price is going down. Plus, US dollar going up. So when you have a few factors, but there are more negative factors than positive factors affecting gold price now, that's the reason why gold price is going down. But if let's say US dollar stops appreciating, one, second is inflation stop being a worry or become a persistent pressure, then gold price will go back up again. So there is a more of a weighing of factors that you might see between what I shared just now. Just now the question there, is it? Any questions? Right, so really, you must understand this one, right? This chart, I'm basing off US dollar gold price. You compare to yen gold price chart or Singapore gold price chart, you might see a very different trend sometimes, right? So gold US dollar chart is actually good. Usually to me is that because it will move in line with US dollar directly. So the movement I can reduce one impact. But if you use Sing dollar or you use yen chart, you have to include in the US dollar movement impact to the price movement. And that might be more complex to see. But as an investor yourself in Singapore, if you want to see your own exposure in gold, you should be looking at the gold Singapore dollar chart. Because that's your actual monetary impact to you. Right? You know what I mean? So, but if you look at the price movement in terms of investment point of view, then gold US dollar is the best. Right? So you must know what you're doing. So if you're holding physical gold, this chart not important one. You only care gold Singapore dollar. Because you are physical gold, you're gonna sell physically anyway, Sing dollar. You're not gonna sell to US dollar. I just bring to US. But if you bring gold out of Singapore and too heavy, be careful, boss. You declare tax later. I know some friends they bring overseas, then they never declare tax, then they got a lot of GST recently. So must stay within a safe zone. Okay, any questions? Yeah. It's always USD, yes. Okay, so investors trading in paper gold or physical gold or ETF or DLC, the difference is that paper gold is still not spot. Okay, so paper gold and physical gold. Paper gold is better than physical gold. It's the price spread between the bid and ask, meaning the buy and sell, is smaller than physical gold. Physical gold, you go there, 1 gram maybe 300 and 280, or maybe 300 and 270 actually. $30 price difference, 10% or even more than that. If you look at paper gold, maybe you look at $5 difference. Or you look at ETF, maybe like $1, 10 cents difference. So the difference starts getting smaller as you get to a more liquid market. So physical gold is the least liquid. Paper gold is the next, because paper gold at least you are more secure, you feel safer. You are holding it in a bank or with a certain company that have a license somehow, in a sense, to trade paper gold. Then you go to spot contracts, futures, larger in base, but more complex in terms of liquidity, in terms of collateral. And look at ETF. So ETF itself have very small spread, but ETF have management fee for long term, which also shared by Marcus. If you hold ETF for long term, you have 2% management fee around there, 2+%, in terms of the difference between the actual performance and the ETF. So there's a cost to you also, right? Compared to you holding physical gold. You hold physical gold, there's no 2%. Right? So some people say, hey, if I buy ETF for 20 years, versus if I buy physical gold and hold for 20 years, which one do I earn more? Actually, surprisingly, physical gold earn more. Because you hold for 20 years, the 2% add up one. Okay? And don't forget, when you say the spread is large, let's say the spread is 20%. Now the gold price is, let's say, 800. A few years back, many years back, 800. 20%. You're looking at a spread between 880 to 720. That zone, right? So you buy 880, can you sell 720? Now it's 3K. 3K and maybe 2.7K, 2.6K. Right? So from 880 to 3K, your ETF, the number of years you eat up more than whole physical gold. So if you really tell me you're going to buy and just hold for forever, then of course maybe physical gold might make sense. But you can't do that in large scale. How many house is worried that you save? Your house safe enough to hold so much gold on? Did someone go, something happened to your house or something, insurance cover a maximum one? Must be careful. So if you really buy physical gold and you put in your house, really look at your house insurance. Don't buy the basic one. Buy higher and take photo. They'll ask you whether you got claim proof that you have gold in your house. I cannot say, hey, I got gold in my house, but no proof. Insurance not pay you one. You must prove that you have the gold in your house. Okay? Or receipt of the purchase. So that's why people still rely on ETF, paper gold, or even the gold balance books, or the futures contracts, right? So for investment point of view. And if you have short-term views, you don't want to invest 20K, 30K in out each time for gold, then 5 times long and short DLC is easier. Only need to deploy 5 times less. So 30K or 40K exposure, you have in a bank, you only need to invest like 6, 7K for the same exposure. So more lower cost means lower fund flow direction movement. First one. Second one is that you also lower commission. Third one also is that your money is still earning interest in a bank. Okay, so technically you have a lower fund direction of cost to you. But if you really want to put in the full amount, also can. No issue. Up to you. Yeah, the choice for yourself. Any questions? Yeah, on there. Yeah. Yes. Okay, very different. So gold miner, if you see, even compared to just gold price, they don't really move in perfect tandem for the leverage. So if you say uptrend gold price, yes, uptrend gold price, gold miners might do better. But in terms of sideways or downtrend, gold miners actually underperform, meaning they drop a lot more than that of the gold price. So why DLC is good is that DLC is good for two ways. You have leverage. First thing, you use less cash for the same exposure. Second part, it's a bad thing to lose money, right? But through DLC, you lose less money. Okay, so it's a very weird thing to think of it this way, but you think of it this way. If you have a wrong opinion of the direction of the investment, okay, you actually lose, let's say 20%. So I got 100K investment, I lose 20% in gold. I lose 20K, I left 80K, correct? 5 times short, I put in 20K cash, 100K position. But it's a consistently negative, right? Trending down. I lose less than 20K actually. I lose a lot, 5 times, for sure. I lose almost my capital, but I'll lose less than 20K. Because 20K invested in DLC will not lose 20K. Very hard. You must lose everything means that really must keep on dropping a very massive amount every single time. Right? So in terms of, if you are not sure if you are right, you just want to try having your opinion, meaning you believe it might go up or go down, then DLC might actually help you to cover that sort of risk. It's a very counterintuitive thing to think of it this way, but you just think of it as per your exposure and your cost to you over time. Anything?
Different stories.
You get 5 times.
You get 5 times on the both long and short. But let me just quickly answer the question first, because you have to understand that really is two different stories. All right. Gold miners is gold play, but also an equities play. All right. Whether the company itself, the miners, can generate revenues, whether they can, their cost is their efficiency enough to generate profits and etc. That plays a part in also the performance of the stock. So yes, they can call it as a leverage play on gold prices, but if you actually look at it more closely, the gold miners also have they are on their own. They're not super correlated to gold as well. They have the equities element. So if you go into a climate where equities is down but gold is up, you will see that you have been better off buying a spot gold kind of ETF or even the DLC that tracks spot gold rather than a gold miner. If one day equities market is down and gold is up. So I think it's two different stories. So if in a sense that if you want exposure to gold prices itself, you want that certainty of gold prices. If it's up this amount on gold prices, you want to make sure that you have that kind of leverage returns, that kind of guarantee. Then you will either look at your gold ETFs or you look at DLCs for gold, because you go up by 2% today or 3% today, doesn't mean that the minor ETF will be up. Also, it could be down also. You never know. It could be up also, but you never know what will it be. Will it be up 3% or will it be up 10%? You don't know. It depends on the equity sort of like sentiment. Yeah. Okay. Sorry. Yeah. So the leverage and inverse exposure, your question was 5 times up, 5 times down. Yes. So if it goes up by 1%, the DLC will be up by 5% for the long one, but the short one will be down by 5%. Cap, meaning?
Your maximum loss is your capital loss.
Yeah. So you put in $1,000, all right, or you buy $1,000 worth of the 5 times DLC on gold. You go up by 1%, this $1,000 value that you put in will go up by 5% from $1,000 every day on a close-to-close basis. Yeah.
So there's a maximum loss in the sense as well. Yeah. Okay, so silver a bit more complex. Silver not like gold, not so many in the vote. So it might not be in a silver vote per se, but definitely it's backed by physical silver. Eventually. This is why I'm saying that there's structural deficiency lah. So there's always a insufficient silver technically in terms of in the Boolean form. There's insufficient in Boolean form, but there's sufficient silver in the world for sure. And silver production is very fast compared to gold. Mm. 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 Yep. 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 There's a ratio, it's not 1:1, but there's enough. SLV, ETF and stuff, their AUC is not very large. Okay. Paper is not. Let's say no. For futures, it's definitely backed by silver, but it might not be in Boolean form. That's what I'm saying. It might not be in the bar form that you are saying, but there's definitely enough silver. The silver is not always in the bar form, you know what I mean? Silver, any silver that you sell to any recycling from silver miner and the plant, the manufacturer and stuff like that, they will take in and it'll be part of the inventory already. They don't always have to make it into a Boolean form. Because silver, technically, in terms of Boolean form, it's not very popular. Because it's very heavy. And very heavy, very cheap money. Very heavy, say 1 kg, not worth a lot of money for silver. So they won't do it and then put it all in silver in terms of the Boolean form, you know what I mean? So usually they will put it in a form that's easiest to keep. Can even be a large overall cast of silver without any cutting out. You know what I mean? So in terms of silver physically, yes, they are backed. But in terms of ask me, if you want to take this paper and go there and redeem, it might not be so easy lah. You will just get 1:1 ratio of the valuation, but you might not be getting the Boolean in terms of the form. Yeah, compared to gold. Gold, if you go to the vault, you cannot get 1:1. You get the full. You want to get the ETF, there's a ratio conversion. You have this valuation, can go down to the vote and say, I want to change. Can. But they don't do it actively. But you can technically do that. Yeah. Okay. Anyone? Yeah. End of this year. Towards next year. Yeah, so basically, I think I mentioned just now is that now the trend is still on the chip makers, the different industrial drivers, also called the industrial leaders, that is using a lot of silver, all right? And they are getting all the contracts now. Means a lot of positivity, a lot of price movement is based on overall of these contracts that they're getting. And Micron getting contract from, let's say, Apple, Broadcom, Apple, that sort of thing. So all the contracts are getting in. So when you have long-term contracts signed up for all these chip makers, right? Then eventually they pump up production. Right? And production pump up means that you need to buy raw material. And raw material is already very expensive. But it's going to get more expensive in future. And that's why eventually, when they become in terms of instead of cyclical contracts, which means that the chipmaker will drop in price, now they're all trying to go towards long-term contracts. If you see Micron and some of the other larger chipmakers, they want to tie down long-term contracts instead to have the profitability being more stable. In that sense, when you have a contract that's stable for Micron and stuff like that, it means that there's a more stable demand for the underlying raw materials. So the raw material underlying demand will be stabilizing, and once that price become more stagnant, or so-called more stable for the current price leaders, like Micron, your TSMC, maybe even Qualcomm, maybe even like WD, Western Digital, then you move eventually to the other segments of the market. So if you compare very simply, you see, 2024, what is the largest or most volatile large cap? NVIDIA, right? 2025 start of year, also NVIDIA. But from 2025 mid-year to end of year, to even now, half a year already, more than half a year, is NVIDIA moving? Not much moving. But is NVIDIA bad? All right, it's still good. They are still having all the contracts. The contract already locked in last year. All the news of the contract, all the new contracts, everything was already locked in 2024 to 2025. All the positivity, all the driving up of the price, generally is already up or out already. So from 2024, 2025 mid-year to now, it's moving just in tandem with the sector performance. No longer like a mega, I I perform this much, I declare my quarterly result, I'm going to pump up as much. No, because they become more expected. So same thing will be the same for all the price leaders now. Eventually, when they already lock in all the contracts, if you lock in contracts for a few years, you confirm have stable expectations of your revenue. Because you're already at max capacity, you're at max production. And why? Because you're also limited by supplier, which is a TSMC, limited by raw material. So eventually, these two parts, the TSMC and raw materials, must go up because there's higher demand for them. So silver is one of them. But for this whole cycle of swings to finish for the current price leaders, it might take 2-3 months, even 4 months, which is from now, July, you add 2-3 months, 4-5 months, that's end of year, which is next year already. So that's my take lah. I'm not always correct. This is my take. This is my personal take. So if you ask my colleagues last time, I was like, end of last year, I already asked to push for memory stocks. Not Micron per se. I never get Micron correct, but I got correct is WD, SanDisk, the memory, the actual HD drivers. But I was saying that if you want NVIDIA to go up, you need Intel to go up. Intel to go up for data centers, you need memory chips to go up. So Micron wasn't really the leader at the point in time. Micron was more of RAM. I was thinking more towards HDD and the so-called the SSD side of things. I didn't think of RAM being so popular lah. But I guess RAM also did very well. Yeah. So that's your take lah. And that's my take. So I'm just sharing because you asked. Yeah. Okay. Any questions? If not, we have to call it. Not outside, they'll ask us. Run already the SGX stuff. Okay. So I hope it was useful to you. My insights and so the sharing by Marcus. All right. So thank you for joining us today. I hope you also find the session useful to you and hope to see you for our next event as well. Thank you.